Okay, let's check we are live then. Let me see a number 1 if you can hear me okay. We'll just give it 30 seconds to a minute for everybody to jump on the stream here. Okay, I can see the chat going. Just give it a minute for everyone to jump in. I can see everyone isn't in yet. Okay. So today I'm not going to be doing anything fancy. I'm not going to be using any of my equipment, all this equipment I've got behind. I'm not going to be using any of it at all. I'm just going to be using the laptop and this little, camera here, the built-in camera, and the built-in audio. So don't expect anything fancy in terms of visual and audio today, but do just rely on the data that's going to be coming through, which is going to be pretty interesting and pretty good, because I usually save the more nitty-gritty finance and economics for the private community, for the Patreon. But we're going to be going into a little bit of it today because we are seeing these indicators flashing red quite heavily at the moment. So, and we've got one indicator that hasn't been seen since the Great Depression, and I think it's quite a crucial one, and I'll show you why, because it all centers around how growth now comes from liquidity. So when liquidity collapses, well, so does growth. So we'll come on to that indicator. Just one quick thing as well, because I saw a couple of people had messaged about this. So my finance courses are not on sale at the moment. They are at full price. So, just for everyone that's messaging and emailing, that they are at full price now, so there's no offers. The next one is coming up, for those of you who haven't taken the courses, is going to be around Black Friday. So if you haven't taken the courses and you want to take the courses, there's going to be a big offer on Black Friday. So I think that is it for announcements. Yeah, and then that'll be the last offer for the year. So if you're waiting on that, it'll be Black Friday. Okay, so let's get into the first article, because I think everybody is jumped on the stream now then. Great, okay. Let's get started with the share. Here we go. Fingers crossed, let's get this going. All right. So we will begin then with this from Goldman Sachs. Why the US money supply is shrinking for the first time in 74 years. Now, bearing in mind this came out, and I've had this since August. So you might say, well, Neil, that's September, October, November time now, or 2 months, two months and a couple of weeks. But as always, I don't just come out with this stuff straight away. I need to wait until I can actually measure the metrics of a lot of this stuff. And this is one of the biggest problems here. They're talking about the US money supply or the decline of the US money supply as a leading indicator for inflation or recession. Well, actually, it's a lot worse than that. And you can see, if we look at this point here, how it's collapsing very heavily. When was the last time it did this? Look to the left of the chart here. Yeah, it was around the Great Depression. Now, I just want to talk about this for a moment, because any of you who are familiar, and if you remember the video, I did a book review on the Great Taking, because you asked for it in the comments. You asked me to do a book review on the Great Taking. So I did that, and you can find it very easily on the channel. It wasn't long ago, or just use the search bar if you haven't watched my review on that video. Now, why is that key? Why am I highlighting that right now? Well, very simply, what was one of the main points of his thesis? It was M2 supply collapsing, leading to a deflationary depression, or a deflationary spiral. And bear in mind, when this book was written, it was quite a long time ago. And I know some people were saying, oh, this book, it's fiction, it's alarmist, it's everything else. There's no possible way that we're going to go into this, deflationary spiral and all this other stuff. Well, the data is actually leading towards that. Thank you for that super chat, Mr. Shovel, 1968. Cool name. So that's where we're leading right now. So let's come back onto this and let's continue on. So the M2 money supply, this is the percentage change from 1 year ago. And I don't want to focus too much on the Goldman Sachs article because it's obviously quite biased based on what they do to earn their living. As we always talk about, you can't always rely on someone who completely earns 100% of their their 9 to 5 paycheck based on giving advice. So this is from Motley Fool or Fool.com, and its US money supply is doing something not seen since the Great Depression. And they're talking about how a big move in stocks may follow. There have only been 5 notable declines in M2 money supply dating back more than a century. Prior dips have signaled deflationary downturns in the US economy. So this is all coming out in the last few days. And look at this, I've highlighted this for you. M2 money supply is enduring its first meaningful drop in 90 years. Is that a headline or what? But we're not really seeing this in the mainstream media. They don't talk about it. And by the way, if you like this kind of content, I actually do a monthly macro video on the private community, which is over on Patreon. There's probably a link below or something. So you can find these sort of videos that I do, in-depth analysis and forecasting and all of that sort of stuff. So if you're interested in that, you can find that there, as well as all the the other fun stuff and renovations, property renovations and posts and everything else. So let's continue on then. This hasn't happened since 1933, and it may portend a big move to come for stocks. So US money supply has 4 measurement standards, of which M1 and M2 are by far the most popular. M1, we've talked about this. This is mainly cash, coins in circulation, as well as what they're calling accessible cash, right? But I would say it's what's in your checking account or your current account if you're in the UK, Europe sort of region. So that's what M1 is. Think of it, if you want to make it really easy, think of it as cash and current accounts. Very simple. Okay. And then when it comes to M2, this is where you're taking all of M1 and you're adding to it market accounts, savings accounts, and CDs or certificates of deposit. That's below 100,000 and they're using US dollars. So they're describing it as, think of this as capital that's still within reach, but it requires more work to get to it. Now, this is the thing that's changing right now and what's really turning heads, as they're saying, is this M2 supply. It is collapsing. Now, there isn't a huge amount of data or analysis right now, so I'm going to give you a little bit of what I feel is happening, because there's all these different theories on where the M2 is going. Personally, I think what's happening is that people are fed up with being ripped off by the banks for years and years and years with these incredible low interest rates on your savings accounts, where you're just not getting good return whatsoever. And the banks are using this liquidity to make billions in profits for themselves. So what I think is happening is, and this is again purely based on me, my own experiences, talking to people wherever I go, even friends and family, I'm seeing it, which would have never happened before. What I think is happening personally is people are starting to move their funds, especially as more and more people are learning now about bail-in law and some of the other risks, and they're seeing banks collapsing. I think people are moving their funds into longer term savings accounts. I think they're moving them into bonds, other things of this nature. That is what I think is happening, although I'm going to have to look into the data a lot more on that. But that is what I think personally is happening with a lot of this. And if you're not getting at least 5% right now on your savings, top tip here, look into that, because there are rates of up to 7%. I saw a 7% rate just last week on savings. Now, there was a tie-in on that, so you've got to look at how happy you are to be tied in. I don't like being tied in on capital whatsoever, because it means if an opportunity comes up, I can't take advantage of it. So again, that just scales. It doesn't matter if you are a millionaire or you've got $1,000 in the bank, right? It scales. Maybe you see an opportunity, someone says to you, I've got this gold coin that's worth 2,000 and I need some cash right now and I'll take 1,000 for it. Well, if your cash is locked up, you can't take advantage of that opportunity. In the same way, if you're a multi-millionaire and some properties come onto the market, you've got an opportunity there. If your cash is tied up, you can't take advantage of it. So that's just my thoughts around that. Now, let's see what else I wanted to cover from this. Okay, so over the last 15 months, M2 reached 21.7 trillion in July. Okay, and since then it's been declining. Mind you, very small moves lower in M2 money supply have occurred dating back more than a century. But it's only happened 5 times where M2 has meaningfully declined by at least 2% on a year-over-year basis. Now, this is why it's really crucial. If you know your economic history, you know what happened in 1878, in 1893, in 1921, in 1931 to 1933. You know what happened during these periods. And the fifth instant was the Great Depression, which began, still argued today, but I would say 1928, 1929, ran through to 1938. So we know that happened. And the last time this happened was the Great Depression. Now, I'm not calling on right now we're having a Great Depression and we're going into this big Great Depression. I think it's very possible. I think it's very likely that we could see a Great Depression. But am I calling for it right now? Again, no. And I've told you that I will let you know if I do think we are going into that. I definitely think that we're in a Great Recession. I think we've been in it for a long time and they've been manipulating the data. That's GDP, that's inflation. I think that's what we've been seeing. I think it's blatantly obvious. I remember when I talked about how the GDP had exploded and everyone was talking about GDP's done so well. And I said, but where's the data? Where's the data? All these news channels and CNBC and everyone else and BBC talking about the GDP exploded. How did it explode? Where's the data for this? So what happened? I looked into that data and found that they double counted their quantitative easing program. So they were creating all this new currency and they double counted it. They counted it when it was created. They counted it again when it was spent. So it's fake. It's not real GDP. They are fudging the numbers. And, even today when I've talked about this, even to economists, they don't get it. They say, no, that couldn't have happened. That wouldn't be morally right and all this. Morally right? Do you know what's going on out there in the world? Do you know what period we are in right now? Let's continue on. Okay, so the significance of this decline is twofold. To start with, there are economic implications of having less capital in circulation. Crucial point. Agree with that 100%. With core inflation still well above historic norms due to higher shelter expenses, consumers may be forced to pare back their discretionary purchases. In other words, declining M2 sets the stage for a potential downturn in the US economy. Absolutely correct. Absolutely right in what they're talking about here. So the second thing to note about the 4 previous notable dips in M2 is that they all led to deflationary depressions. What was the book? The Great Taking talked about this, with double-digit unemployment rates. Let's see what else I wanted to... Okay, I wanted to just bring up the chart then so you can see this for yourself, because people sometimes say, well, Neil, I can't see it. What are you seeing? What are you reading? So I'm grabbing the data, and you can see in this bar here, always look, if you want the sources of this, what I'm talking about, always look at the bar here. And that is the Fred data, and you can see the series, it's the M2, real M2 money stock. And you can see it is absolutely falling off a cliff. This is the fastest decline I've seen in a long-term time. And if you want a definition of it as well, you can go over to Investopedia. Whenever you want to learn about some of the, and again, I say this on the private community in the videos, if you ever want to learn some of this stuff, head over to Investopedia and just type it into the search bar here, and you can pretty much find anything. Let's say you wanted to learn about QE, right? Here we go, how quantitative easing affects the stock market, right? Next thing I wanted to look at then was another article from motleyfool.com, and they talked about, this is a sort of flip here, so we'll look at this side. They talked about 2020, the crash plunged all three indexes into a bear market in the space of 5 weeks. Now that was a fast turnaround. In 2021, the Dow Jones, S&P, and the Nasdaq ramped to multiple all-time highs. How did that happen? We covered that previously. It was from all the QE, the new liquidity that pumped into the markets. And then last year, all three of the indexes as well plummeted into a bear market. So remember, bull market, market is rising, bear market, the market is falling. If you don't understand some of these terms, just a reminder, at the end of the month, Black Friday, the finance courses will go on sale, so you can learn all about this sort of stuff. And you know, I love learning. I don't know about you guys, but I absolutely love learning all of these things. So this year then, all three indices or indexes have bounced meaningfully off their lows and have, by at least one definition, kickstarted a new bull market. That's their opinion. Okay, that's their opinion. While most investors will gladly accept a continued running of the bulls, a new sobering update for Wall Street by American banks could quickly change that tune. Now, let's see if we want to go. There's a lot to cover, so I don't know how much we're going to get through here. But yeah, this is quite crucial, actually. I do want to cover this. Now, this was from the SLO, and this was their opinion, so the Senior Loan Officer Opinion Survey. And it showed that more than 50.8% of domestic banks are tightening their lending standards for C&I loans to large and middle market firms. That's up from 46% in the sequential second quarter and right in line with levels observed during previous US recessions. Key. Since 1990, a reading above 50% has always been followed by, again, keyword always, or immediately preceded by a recession. So this is another indicator that we are seeing. If banks aren't willingly lending to businesses like they once were, the expectation is a slowdown in hiring, in innovation, remember R&D, research development, along with a meaningful drop in acquisition activity. These are your mergers and acquisitions. In short, it's a recipe for an economic slowdown, if not a full-blown recession. Historically speaking, about 2/3 of all losses in the major stock markets occur in the year following the official declaration of a US recession. We won't go through all the additional M2 because we've covered that quite a lot. But should we cover this? Okay, really quickly, let's just cover this really quickly. Because I did see this article and I was going to use it as a sort of later on if we had time. But it's quite funny, some of the data that I was reading from some of these news outlets, which is actually incorrect. So there was a CNBC poll of roughly 300 money managers, and 60% of them see the markets gain this year as nothing more than a bear market bounce. In contrast, 39% believe a new bull market has arrived. Of course they do. Of course they're going to say that. And then 64% believed the US economy would enter a recession by mid next year or later. It's funny, whenever you ask them, they'll always put it back by sort of 6 months or so. They never say, oh, I think it's going to come in the next few months. And now this is the other survey by one poll, which made me laugh. Apparently, 3 out of 4 Americans stated in their poll that they are ready for this recession. Absolute nonsense. 3 out of 4 people did not say they are ready for this recession if it comes. It's absurd. The next thing, I've highlighted this in red because they have got this massively incorrect. And it says the increased savings rate help explain this assuredness. Again, it's not assuredness because 3 out of 4 people didn't say it. But anyway, the US personal savings rate reached 4.3% in June, up from a 15-year low of 2.7% in June 2022. They do not know what they are talking about. Here is the data from the Fed. Here was the savings rate. Okay, you look at it, what it was in April 2020, 32%. It came down to 12% because this was stimmy money. it went back up, 19.3. I wonder what these spikes coincided with. What a mystery. Drop it in the comments if you know. It went back down. It went back up to 26% again. Now, here's them talking about, where was it? June of 2022. Okay, in fact, what did they say? June, 15-year low, okay, of 2.7%, but it went back up to 4.3%. Did it really? Well, what is it now? It's back to 3.4%. They are months out of date on their data here. So what they are putting out is just incorrect. They are giving false information here, which is pretty crazy. But the euro, this is not just for the US, this is for the UK and the Eurozone as well. We've just had an article out from the irishtimes.com, and this talks about Eurozone retail sales weaken further as recession fears grow. And the sales in 20 countries sharing the euro fell by 2.9% year on year in September. So we can see where all of this is leading to. We can see the signs quite clearly. Another one, this was from Business Insider, put on Yahoo News. Gosh, look at his breath. He's cold. That looks like Davos. I wonder if he's at Davos having this meeting. It's always the same scene. Always the same scene at Davos. The flag's behind. They're warm with a cold breath. All the signs are pointing to a recession that'll cost Americans their job. This is what this veteran bond investor says. So he's talking about how the layoffs are coming. I'm pretty sure that's Davos. Drop it in the chat if you know. But either way, he said the US economy is lurching toward a recession. He talked about the de-inverted bond yield curve. We haven't got time to get into that actually, because that's it's gonna require some explaining. But he's also talking about the rising unemployment rate as signs of a looming slump. Again, if you want to learn about the bond yield curve, you can go on Investopedia and it will teach you a lot about that. It's worth knowing because it is a recession indicator. Layoffs are coming. He said the US economy is clearly headed toward a recession. Yeah, I think that's about good for there. And I got a couple of notes on my tablet I just wanted to cover. Check that I've covered everything. I always laugh when I see in the chat someone says, doom and gloom, he makes up all doom and gloom. It always makes me laugh when I see this in the chat. No, it's called analysis. I'm looking at the charts and giving economic warnings. Goodness me. That one always makes me laugh when I see that. Let's see if there was anything else I wanted to cover. There was one thing about the UK. Yeah, we've also got an indicator for the UK as well. This has been flashing red this week. And again, it's also from the money supply. I just noticed this here in my notes. M2 again. Broad money supply has fallen by 4.2%. So this is the deepest fall ever on record for the UK. So we've also got it happening in the UK. Yeah, the Bank of England made a statement. There was a meeting which, again, made me laugh, this one. So the Bank of England acknowledged its role in squeezing the money supply via quantitative tightening, but argued that this had not had a negative impact on the economy. That was their statement. And when pressed, they said that because with the economy shrinking, this is positive for inflation and other metrics, because if you're not going to believe the stuff they say, but they say that if people lose their jobs, this is positive because it brings down inflation, because people don't have the money to then spend into the economy. This is crazy. This is backwards thinking. It's like when Hugh Pill, was it? He said UK citizens need to get used to being poor. Sorry, it's just the fact of life. Remember when I talked about this on the Walk and Talk? He's not going to get used to being poor. Some of these other people are not going to get used to being poor. making people lose their jobs in order to bring down inflation is ridiculous. I honestly can't believe this is one of their strategies. It is absolutely bonkers. Do they not realize that then the tax revenue they would have got is not coming in? They're not paying the taxes, they're not spending, they're not getting the government's not getting the VAT and the sales taxes and all these other things. It puts you into a doom loop, and the doom loop puts you into it puts you into all sorts of things, but employment scarring is one of the biggest ones. And then people aren't spending into the economy, they're not spending in shops. It just gets worse and worse and worse. I mean, these people, it's absolutely baffling to me. It really is that that they continue on, with all this stuff and the things they say. It's absolute madness. All right, I think that's it. See you tomorrow.